Jordan, it feels like as we get more towards that central bank convergence, when you have different central banks taking the lead on FX, on the treasury market, on the rates market, you're in for some difficulty as an investor.
You are, because you have to remember as well, we focus on the sterling, the FX rates all day long, but that's not what the Bank of England does. They look at the economic situation of the UK, for example, and there's a reason why the Bank of England's moving a bit more optimistic. It's because things aren't as bad as what they thought, but also there's rising inflation pressures. Some of them are domestic as well. The main point they keep saying is a lot of the inflation we're seeing is from the FX devaluation. Yes, of course, but there is a rising domestic component which is picking up, and that is what they're looking at. And it's also the build-up of leverage in the system. So we're seeing debt-to-income ratios rising once again. So this is good to have a Bank of England that's looking to hike when things are picking up in terms of debt-to-income ratios, for example, because it tells you in the later part of the cycle when you've got unemployment at 1970s lows. So for now, it's not going to be helpful for markets in terms of the FTSE, because the higher the FX rate goes against the dollar, for example, in cable, the lower the FTSE will go just because there's an FX component of earnings. But it's not like the global economy is faltering. So this is a central bank that's hiking with a global synchronized upturn. So I think this is a market that needs to get to grips with more positivity in terms of the outlook, and therefore more hikes in the curve.
Well, sure, but Steven, if you look at the curve, the market's now expecting 3 rate hikes in the next 3 years from the BOE, barely expecting 2 from the Fed.
Right.
Where is the biggest misunderstanding?
Well, look, you're adding the additional impact of balance sheet unwind in the United States.
Which they say is not going to have any impact.
Well, look, I think, there's a very good chance now that markets are underrating where the Fed will be. Even the Fed's own forecast is half a traditional hiking cycle over the next several years, and markets are predicting even less than that. So I think that this is an issue. But when you say that everything is driven by central banks, come to grips with the fact that, all throughout the QE period of the last 10 years, global equities and forward-looking earnings over 6 months have been correlated. The changes have been correlated, plus 70% correlation. Again, why are U.S. stocks up 11%? Earnings first half of the year, plus 13%. Why are tech stocks up 20%? First half EPS, plus 20%. Why did oil move up and down? Supply and demand. Not everything can be blamed on central banks, and certainly they won't solve all of our problems either.